In the last 12 months, the chief executive officers and founders of the world's largest technology companies have sold over $160 billion worth of their own stock. $160 billion. That is the highest volume of insider selling in a single year since the peak of the dot-com bubble in the year 2000. And it is not slowing down. In the first quarter of 2025 alone, they have accelerated the selling pace, liquidating billions more every single week. We are talking about Jensen Huang of Nvidia, Mark Zuckerberg of Meta, Jeff Bezos of Amazon, the Walton family, and the trust funds behind the largest shareholders of Apple and Tesla. Even executives at companies you assume are invincible are cashing out like it is the last chance they will ever get. And here is what should terrify you. Corporate insiders are not retail investors. They do not panic sell because they saw a negative news headline. They do not sell because they need money for a new yacht. These people are already billionaires. When insiders with that level of access all start selling the same assets simultaneously, they are not diversifying, they are exiting. They are preparing for what? The collapse of the AI bubble, the erasure of $10 trillion in paper wealth, and a valuation reset that will drag the Nasdaq down by 70%. It is the same playbook the insiders used in 1929 and 2000, and you are about to watch it happen in real time. In this video, I am going to show you exactly what the tech oligarchs see that you do not. I will show you the private revenue data they have access to, the saturation timeline they are following, the specific mechanism they are using to unload their shares on retail investors before the crash, and most importantly, what you need to do right now before it is too late. Because once this executes, once the earnings misses start and the algorithmic selling begins, there is no going back. You will either be in cash and short positions like the smart money, or you will be collateral damage with everyone else holding Nvidia at the top. Let me show you which side you need to be on. Let me start with the numbers, because the scale of what is happening is unprecedented. According to Securities and Exchange Commission filings, which track official insider transactions, tech executives sold more stock in 2024 than in the previous 5 years combined. For context, before 2024, the previous record for insider selling was set just before the Nasdaq crashed 80% in the early 2000s. We are in uncharted territory. And it is not just the volume, it is who is selling and why they are selling. Look at Nvidia. Jensen Huang, the visionary CEO, has been selling hundreds of millions of dollars of stock every single month. He is selling into the hype. When retail investors are screaming that Nvidia is going to $10,000 a share, the man who runs the company is hitting the sell button. Why? Because he understands the hardware cycle better than anyone. He knows that the massive capital expenditure boom from Microsoft, Google, and Meta cannot last forever. He knows that once the data centers are built, the orders stop. He sees the cliff coming in 2025. And he is securing his fortune before the market realizes that infinite growth is mathematically impossible. Look at Apple. Warren Buffett, the greatest investor of all time, cut his Apple stake by 50% in 2024. 50%. He did not just trim the position, he decapitated it. Berkshire Hathaway now holds a record $300 billion in cash and short-term treasuries. Think about that. Warren Buffett would rather hold cash, which loses value to inflation, than hold the most profitable company in the world. Why? Because he knows valuations are disconnected from reality. Apple is trading at 30 times earnings with zero revenue growth. That is a bubble metric. Buffett knows that when the consumer recession hits in 2025, people will not buy the new iPhone. They will buy food. He is getting out before the valuation reverts to the historic mean of 15 times earnings, which would imply a 50% drop in Apple's stock price overnight. Look at Tesla. Elon Musk has been selling stock consistently, ostensibly to fund other ventures. But the timing aligns perfectly with the deterioration of Tesla's fundamentals. Margins are collapsing. Competition from China is eroding their market share. The electric vehicle mandate is being pushed back globally. Tesla is priced like a high-growth software company, but it is trading in a low-margin automotive reality. Musk knows that if Tesla is repriced as a car company, the stock falls 90%. He is ensuring he has liquidity before the market wakes up to that reality. Now, here is what connects all of these sales. Every single one of these insiders is preparing for the same event. The end of the liquidity cycle, the collapse of the passive investing bubble, and the transition to a structural bear market. They do not know exactly what the catalyst will be. Maybe a geopolitical conflict over Taiwan that freezes chip supply. Maybe a resurgence of inflation that forces the Fed to hike rates to 8%. Maybe a massive corporate credit default cycle. But they know the current valuations cannot hold. You can not have the S&P 500 trading at 25 times forward earnings when interest rates are 5%. The math does not work. In the transition from a zero interest rate world to a higher rate world, valuation multiples must compress. This is why insiders are selling at levels not seen in 25 years. They are preparing for the valuation transition, and that transition is being accelerated by something most people are not paying attention to: the Magnificent Seven concentration risk. For the last 2 years, the entire stock market has been propped up by just 7 companies: Nvidia, Apple, Microsoft, Google, Amazon, Meta, and Tesla. If you remove these 7 stocks, the S&P 493 has basically been flat or down. This creates a massive structural weakness. It is like a skyscraper resting on 7 toothpicks. If just one of them snaps, the whole building comes down. Let me show you exactly what is happening behind the scenes that the financial news networks will not tell you. The algorithmic trading systems that control 80% of daily volume are programmed to sell everything if volatility spikes. This is not a theory. This is market structure. These systems use leverage to chase momentum. When Nvidia goes up, they buy more. But the moment the trend breaks, the moment Nvidia misses earnings or lowers guidance, these algorithms flip. They become forced sellers. They do not care about the long term. They sell to protect capital. And here's how the crash happens. It starts with one disappointment. Let us say it is Nvidia in mid-2025. They report earnings, and for the first time in 3 years, they say demand is slowing. The stock drops 20% in after-hours trading. This triggers margin calls for hedge funds that were leveraged long. To meet those margin calls, they have to sell their liquid winners. They sell Apple. They sell Tesla. They sell Bitcoin. Suddenly, everything is falling at once. This triggers the passive index funds. When people see their 401k drop, they panic and sell. The index funds are forced to sell the underlying stocks to meet redemptions. It becomes a feedback loop of selling that feeds on itself. This is exactly what happened in the year 2000. Cisco Systems was the Nvidia of that era. It was the company building the plumbing of the internet. Everyone said you had to own Cisco. It traded at 100 times earnings. It was the most valuable company on earth. And then, one day, they announced that their customers had built too much inventory. The stock fell 85% and had never recovered to its previous high. Not in 5 years. Not in 20 years. Never. Nvidia is following the exact same chart pattern as Cisco in 2000. The parabolic rise. The retail euphoria. The this time is different narrative. And corporate insiders know it. That is why they are selling. They are handing the bag to you. Now, I need to take you deeper. What I have shown you so far is the surface level crisis. It is the visible part of the iceberg. But the reason insiders are selling $160 billion in stock is not just because valuations are high. It is because they know there is a structural rot underneath the market that the public does not even know exists. This is the shadow risk, and when it breaks, it will make the 2008 financial crisis look like a dress rehearsal. Let us talk about the shadow banking bubble. In 2008, the crisis came from subprime mortgages. Banks lent money to people who could not pay it back. Today, the crisis is coming from private credit. This is a $2 trillion market where non-bank lenders, hedge funds, and private equity firms lend money to struggling software companies that cannot get a loan from a normal bank. Here is why this matters to your Nvidia and Apple shares. Much of the growth in the tech sector right now is being fueled by this debt. Companies are borrowing money at 10 or 12% interest to buy AI chips from Nvidia to make it look like they are growing. It is a circular financing scheme. They borrow money to buy chips, which boosts Nvidia's revenue, which boosts Nvidia's stock price. But the companies buying the chips are not making a profit. They are drowning in debt. Insiders know that this private credit bubble is about to burst. Default rates in the private credit sector have doubled in the last 6 months. When these zombie companies start defaulting, they will stop buying chips. Nvidia's order book will evaporate overnight. The revenue will not just slow down, it will collapse. This is the air pocket scenario, and the executives see it in their internal credit reports. They know their customers are insolvent. They are selling their stock because they know the revenue they are reporting today is based on debt that will never be repaid. Now, let us look at the accounting mirage of the Magnificent Seven. You look at Microsoft or Google and you see massive profits. You assume they are safe. But insiders know that a huge percentage of those profits are what is called mark-to-market gains on their own investments. Tech companies today operate like hedge funds. They invest billions in AI startups. When they invest in an AI startup, they often require that startup to spend that money on their cloud services. Microsoft invests $10 billion in OpenAI. OpenAI then pays Microsoft billions for cloud computing. Microsoft records that as revenue and profit. It is moving money from the left pocket to the right pocket and calling it growth. This creates an artificial earnings loop. It inflates the price-to-earnings ratio. It makes the stock look cheaper than it is. But what happens when the startup bubble bursts? The investment value goes to zero. The cloud revenue goes to zero. The earnings per share collapse. The stock price crashes. This is the hidden leverage in the system. Insiders like Satya Nadella and Sundar Pichai understand this fragility. They know that if the AI hype cycle slows down even by 10%, this circular financing machine breaks. That is why they are selling. They are cashing out the paper profits before they have to write them down to zero. We also need to talk about the geopolitical black swan that every central bank and tech CEO is preparing for, the Taiwan blockade. Nvidia does not manufacture its own chips. They design them. The chips are manufactured by one company, TSMC, the Taiwan Semiconductor Manufacturing Company. TSMC produces 90% of the world's advanced AI chips. They are located on an island that China claims is its own territory. U.S. intelligence estimates that China is preparing for a blockade or invasion of Taiwan by 2027, but potentially as early as 2025. If China places a naval blockade around Taiwan, even without a full war, the supply of Nvidia chips goes to zero. Not down 10%, zero. Apple relies on the same supply chain. Tesla relies on the same supply chain. If TSMC goes offline, the revenue of the Magnificent Seven stops. The global economy stops. A 70% drop in stocks would be optimistic in that scenario. It would likely be 90%. Do you think Jensen Huang is unaware of this? Do you think Tim Cook does not have daily briefings on the tensions in the South China Sea? Of course they do. Why do you think Warren Buffett sold half of his Apple stock? He explicitly stated that geopolitical risk was a factor. He did not want his fortune tied to a supply chain that sits in the crosshairs of a global superpower conflict. He moved his money to U.S. Treasuries, the safest asset in the event of war. If Warren Buffett is de-risking from Taiwan, you should be too. Now, let me show you the mechanism of how this crashes the market and erases your wealth. Because this is where it gets really sophisticated. The market is currently pricing in perfection. It is pricing in that AI will revolutionize the world immediately, that profits will double every year, and that the economy will never have a recession again. But the reality is, the economy is cracking. Consumer delinquencies on credit cards are at the highest level since 2008. Corporate bankruptcies are rising at the fastest pace since the pandemic. Commercial real estate is a slow-motion train wreck waiting to destroy the regional banks. The only reason the stock market has not crashed yet is because of the AI narrative. It is the last story holding up confidence. Watch what happens when the narrative breaks. The mechanism is called multiple compression. Right now, investors are willing to pay $30 for every $1 of earnings Nvidia makes. That is a PE ratio of 30. In a bear market, when fear takes over, investors might only be willing to pay $10 for that same dollar of earnings. Even if Nvidia's earnings stay the same, if the multiple compresses from 30 to 10, the stock price falls 66%. But earnings will not stay the same. In a recession, earnings fall. So you get a double whammy. Earnings fall by 50%, and the multiple falls by 50%. The result is a 75% drop in the stock price. This is the math of a crash. This is what insiders see coming. And this is why they are selling before the multiple compression happens. Let me show you the 3 types of intelligence insiders have that you do not. This is why their selling is a signal you cannot ignore. First, they see real-time demand data. Jensen Huang does not need to wait for a quarterly report to know if sales are slowing. He sees the order book every morning. He knows if Microsoft is canceling orders. He knows if Amazon is delaying shipments. When he sells stock, it is because the forward-looking data is turning negative. He is reacting to information that you will not see for another 6 months. Second, they have access to government and regulatory chatter. The executives at Google and Apple know the Department of Justice is coming for them. They know the antitrust lawsuits are serious. They know that breaking up these monopolies is a political winner for both parties. If Google is forced to divest Android or Chrome, the stock gets crushed. If Apple loses its grip on the App Store fees, their margins collapse. Insiders are selling because they know the regulatory hammer is about to drop in 2025. Third, they understand the cycle of innovation better than the public. They know that AI is currently in the hype cycle. We've built the infrastructure, but the profitable applications are not there yet. Companies are spending billions on AI chips, but they are not making billions in return. This is exactly what happened with the internet in 1999. Everyone built fiber optic cables, but there was no Netflix or YouTube yet to use them. The infrastructure build-out collapsed because it was too early. The same thing is happening with AI. We are building massive data centers that will sit empty because the software is not ready. Insiders know this air pocket in demand is coming in 2025. Now, let me show you the timeline because this isn't happening in 10 years. This is happening now. Phase 1 is late 2024 through early 2025, the distribution phase. This is what we are in right now. The stock prices are holding steady or slowly grinding higher, but the volume of insider selling is massive. The smart money is distributing their shares to the dumb money. They are keeping the price high to attract retail buyers while they exit. You see this in the volatility? The market swings wildly, but goes nowhere. This is distribution. Phase 2 is mid-2025, the catalyst. This is when the bad news finally hits. It could be an earnings miss from Nvidia. It could be a credit event at a major bank. It could be a spike in unemployment. Whatever it is, it breaks the trend. The institutional algorithms switch from buy the dip to sell the rip. The 200-day moving average breaks. The technical support levels fail. This is when the slide begins. Phase 3 is late 2025 through 2026, the capitulation. This is when retail investors finally give up. After holding through the first 20% drop, thinking it will come back, they watch it drop another 30%, they panic. They sell at the bottom. This is the puking phase where volatility hits 50 or 60. This is where the market bottoms. This is where fortunes are lost, but it is also where fortunes are made if you are holding cash. Now, I want to address the psychology of what is about to happen, because understanding the math is only half the battle. You need to understand how your own brain will trick you into losing money. A market crash follows a very specific emotional pattern. We are currently in the denial and euphoria phase. This is the phase where bad news is ignored. Inflation goes up, the market rallies. Unemployment goes up, the market rallies. Investors believe the AI revolution is so powerful that economic gravity no longer applies. This is exactly how people felt in 1929. They called it a permanently high plateau. This is how people felt in 1999. They said, profits don't matter. It's the new economy. The next phase is anxiety. This will happen in 2025 when the stock drops 10% and does not bounce back immediately. You will tell yourself, it is just a correction. It is healthy. You will hold. Then comes fear. The market drops 20%. The news anchors start using words like recession and crisis. You start checking your portfolio 5 times a day. You lose sleep, but you still hold because you do not want to lock in a loss. You tell yourself, I will sell when it gets back to break even. Then comes panic. The market drops 30 or 40%. A major bank fails. A hedge fund blows up. Your friends are selling. Your family is telling you to get out. The pain of losing money becomes greater than the hope of making money. Finally, there is capitulation. This is the bottom. This is when the market is down 50, 60, or 70%. This is when you cannot take the pain anymore. You sell everything just to stop the bleeding. You vow never to buy stocks again. In that exact moment, the moment you sell is the moment the insiders start buying. This cycle is biological. It is hardwired into human nature. The only way to defeat it is to have a plan before the panic starts. That is why I am telling you to raise cash now. If you are sitting on 50% cash, you do not panic when the market falls. You get excited. You see it as a sale. You see it as an opportunity to build generational wealth. Preparation is the antidote to panic. Let us look closer at the historical parallel of 1929 because the similarities are terrifyingly precise. In the 1920s, the revolutionary technology was not AI, it was the radio and the automobile. RCA, the Radio Corporation of America, was the Nvidia of its day. It went up 500% in a few years. Everyone had to own it. It was changing the world. And it did change the world. Radio was a massive innovation. But the stock price had detached from reality. When the crash of 1929 hit, RCA fell 97%. It took decades to recover. The technology succeeded, but the investors failed. We are seeing the same pattern with the concentration of the market. In 1929, the market was held up by a few massive trusts and utility companies. Today, it is the Magnificent Seven. The breadth of the market, the number of stocks actually going up, is incredibly weak. This is called negative divergence. The generals, Nvidia, Microsoft, are charging up the hill. But the soldiers, small caps, industrials, banks are retreating. When the generals finally fall, there is no support beneath them. Insiders are also watching the yen carry trade. This is a complex financial mechanism, but I will simplify it because it is the ticking time bomb of global liquidity. For years, hedge funds have borrowed money in Japan for free, literally 0% interest, invested that money in US tech stocks. This injected trillions of dollars of artificial liquidity into the Nasdaq. But now, Japan is raising interest rates. The free money spigot is being turned off. We saw a preview of this in August 2024 when the market dropped 10% in 3 days. That was a warning shot. When Japan normalizes its rates in 2025, Trillions of dollars will have to flow out of U.S. tech stocks and back into the yen to pay off those loans. This will trigger a forced liquidation event, regardless of how good Nvidia's earnings are. It is a mechanical selling event. The insiders are front-running this flow. Now, let us talk about what happens to the passive investor. Millions of Americans are told to just buy the S&P 500 and hold. They put their money in Vanguard or BlackRock funds every 2 weeks. This works in a bull market. It creates a blind buying pressure, but in a crash, it creates a blind selling avalanche. As baby boomers retire and 10,000 of them are retiring every day, they become net sellers of stock. They need to cash out their 401 kiloseconds to pay for living expenses and medical bills. For the last 40 years, boomers were buying. Now, they are selling. This is a demographic tidal wave that no amount of AI hype can stop. We are moving from a cycle of accumulation to a cycle of distribution. Who are they selling to? If the millennials and Gen Z are broke, and the foreigners are de-dollarizing, who buys the stock? The answer is, nobody. And when there are sellers and no buyers, the price crashes until it finds a buyer. That buyer will eventually be the insiders, but only after the price has fallen 70%. You might be thinking, but I am a long-term investor. I will just hold through it. That is a dangerous mentality when you are dealing with a bubble. If you bought Cisco at the top in 2000, you are still down in real terms 25 years later. If you bought RCA in 1929, you never got your money back. Some stocks do not come back. And even if they do, waiting 15 years just to break even is a financial disaster. You lose the most valuable asset you have: time. So, what about the safe havens? I mentioned gold and cash, but we need to talk about the specific strategy for surviving the transition. You need to understand counterparty risk. In a systemic crash, brokerage firms can fail. Banks can freeze withdrawals. We saw this with Silicon Valley Bank. We saw this with Robinhood turning off the buy button. When you position for the crash, you need to ensure your liquidity is accessible. This is why ultra-high net worth individuals hold treasury bills directly, not just through a money market fund. They hold physical gold, not just a paper ETF. They diversify across jurisdictions. They are preparing for a period where the financial plumbing itself gets clogged. You also need to understand the fake wealth effect. Right now, you feel rich because your house is up 50% and your crypto portfolio is up. But this is phantom wealth. It is based on the same bubble valuations as stocks. When the stock market crashes, the wealth effect reverses. People feel poor. They stop spending. The housing market freezes. Crypto, which is highly correlated to tech stocks, crashes in tandem. Do not make the mistake of thinking your house or your Bitcoin is a hedge against the stock market crash. So, what is the action plan? What do you do this week, this month, and over the next year to position correctly? First, look at your portfolio concentration. If you have more than 20% of your net worth in the Magnificent 7 stocks, you are dangerously exposed. You are betting your financial future on a narrative that is already cracking. Consider trimming those positions. You do not have to sell everything, but take your initial principal off the table. If you doubled your money on Nvidia, sell half. You are now playing with house money. If it crashes, you do not lose your savings. Second, raise cash. Cash is not trash in a crash. Cash is a call option on every asset in the world. When the market falls 50%, the person with cash is king. You can buy high-quality assets for pennies on the dollar. Warren Buffett has $300 billion in cash. He is waiting. You should be waiting too. Aim to have at least 30 to 50% of your portfolio in cash or short-term treasuries yielding 5%. You get paid to wait? Third, consider defensive assets. Gold, utilities, consumer staples. These are boring, but they survive crashes. When the tech bubble bursts, money often rotates into real assets. We saw this in the 2000s. While the Nasdaq collapsed, gold and value stocks began a massive bull market. Fourth, learn how to profit from the downside. You do not just have to sit there and lose money. You can buy put options. You can buy inverse ETFs that go up when the market goes down. You can short sell. These are advanced strategies, but in a structural bear market, they are the only way to generate significant returns. Start small. Learn how they work. Prepare to use them when phase 2 begins. Finally, ignore the noise. The financial media exists to sell you ads, not to make you money. They will tell you to buy until the very last moment. They were telling you to buy Lehman Brothers the day before it went bankrupt. They were telling you to buy Enron the week before it collapsed. They are telling you to buy Nvidia now. Do not listen to what they say. Watch what the insiders do. And the insiders are screaming at you with their actions. They are selling $160 billion of stock. They are building bunkers. They are moving to cash. They know what is coming. Now you know the year 2025 will be the year of the great reset for the stock market. The valuations will revert. The bubble will burst. The wealth transfer will happen. It will transfer wealth from the unprepared to the prepared. From the passive investor to the active investor. From the optimist to the realist. If this video showed you what the insiders see that you do not, subscribe right now. Over the next 12 months, I will track every major insider sale, every change in the technical structure, and every signal that indicates phase 2 has begun. I will guide you through the crash, month by month. Because the difference between panic selling at the bottom and buying at the generational low is information. The insiders have made their choice. They are out. Now, you need to make your choice. Follow the smart money or hold the bag. Position with the billionaires or go down with the ship. The timeline is set. The window is closing. And once the crash happens, once Nvidia is down 70% and your portfolio is cut in half, it is too late. You cannot undo that. You can only position before it happens. The choice is yours. Choose wisely.